All right, let's talk Dixie Group, ticker DXYN. We just got their Q2 numbers, and honestly, there's a really interesting story brewing here. You've got a company that's firing on all cylinders internally, but it's fighting against some serious economic headwinds. So let's break it all down.
Okay, so here's how we're going to tackle this. First, we'll hit the big numbers, the earnings snapshot. Then, we'll get into management's playbook. How are they making this happen? After that, we'll see how the market is feeling about all this. And finally, we'll give you our take, the next call, with our rating.
All right, first up, the earnings snapshot. Let's get right into the numbers from this past quarter.
So the big headline number, the one everyone looks at first, is earnings per share, and it came in at 8 cents. Now you might think, 8 cents, is that good? Well, yeah, it's double what they did this time last year. That is a really strong performance on the bottom line.
But this is where things get really interesting. Take a look at this. Revenue actually went down a little bit, right? But then look at gross margin. That went up, and net income, it doubled. So what does that tell you? It tells you this is a company that is executing incredibly well. They're finding ways to be more profitable, even with slightly lower sales. It's that classic doing more with less playbook.
So the big question is how? How on earth do you double your profit when your top line is shrinking? Well, that's where we need to look at management's playbook to see what's going on under the hood. Okay, the number one reason is this: a massive $12.6 million savings plan for the year. And get this, they're only 6 months in, and they've already hit about half of that goal. This isn't just some goal on a slide deck. These are real cost reductions hitting the bottom line, which is exactly why we're seeing those margins pop. And this isn't some new panicked reaction either. The CEO, Dan Frierson, said it right on the call. Doing more with less has meant reducing costs by well over $50 million. $50 million. That's over the last 3 years, so this shows a long-term, super disciplined focus on efficiency, and it's really paying dividends right now.
But it's not just about cutting costs, right? You can't shrink your way to greatness. They're also being smart. They're focusing on their premium brands. That's where the better margins are. They're shifting supply chains out of China to dodge some of those tariff headaches. And they're being super stingy with capital expenditures. It's a really well-rounded, smart strategy.
Okay, so we've got great execution, improving profits. The stock must be soaring, right? Well, that brings us to the market's reaction, and this is where the story takes a turn. This really sums up the whole conflict perfectly. You have the bull case, which is all about the company's internal strength. Look at this list. Doubled EPS, better margins, less debt. It's all great stuff. But then you have the bear case, and it has nothing to do with the company itself. It's all about the nasty stuff happening outside. Interest rates, consumer confidence, and, the big one, a really tough housing market. In that bear case, that's what we in the biz call macro headwinds. Think of it like trying to swim upstream against a really strong current. No matter how good of a swimmer you are, that current is going to slow you down. And that's what's happening to Dixie Group. So what happens when an unstoppable force meets an immovable object? Well, in this case, pretty much nothing. The stock price was basically flat after they announced these fantastic results. It didn't budge, and that tells you everything you need to know. Right now, the market is way more scared of the bad economy than it is excited about Dixie's great performance.
So, that's the situation. Where do we go from here? Let's get to our final section, the next call. Time to put it all together and give you our take on what's next.
Okay, let's just ask the question that's on everyone's mind. Is Dixie Group a buy? You've got great numbers, the stock looks cheap, so is it time to jump in?
Well, before we can answer that, you have to remember what this company actually sells. A huge chunk of their business, like 85%, is soft surface flooring. We're talking carpet. And what drives carpet sales? People buying and remodeling homes. So Dixie is tied directly to the housing market. And that's exactly where all the economic pain is right now. So here's our prediction for Q3. We think those awesome margins around 29% are here to stay. That cost control is the real deal. But the revenue side, we just don't see anything on the horizon that's going to make sales pick up. As long as the housing market is in the doldrums, their revenue is going to be challenged. Simple as that.
And for the stock price? Yeah, we think it's going to be range-bound. It's basically stuck in neutral. Think of it as a car that's perfectly tuned up. Great engine, but it's stuck in a massive traffic jam. Until that traffic, the bad housing data, starts to clear up, this stock just isn't going anywhere fast.
Which leads us to our final rating, market perform. Now, what does that mean? It means this is a fantastic company stuck in a really tough spot. They are doing literally everything right internally, but We just don't see the stock outperforming the overall market until those big external economic pressures start to ease up.
This is not financial advice.